Hi everyone, welcome to day 2 of the SBL webinar. Well, today I'll be taking you through the rest of the technical areas. So to begin with, we will be starting with governance and general principles. It's a key topic when it comes to case study examinations. Topics like governance, stakeholders, strategy, leadership, the high level matters. So you must place or focus more on these areas for better understanding and clarity when you write answers. So we'll be looking at the definition of the key concepts along with the stakeholder theory and also the agency theory. Right, moving on. Governance is about the system by which companies are directed and controlled in the interest of shareholders and other stakeholders. Now, if you look at companies and the way they conduct their businesses, especially with famous scandals in corporate, governance have gained more importance, and even the textbooks now talk in length about good governance in company or corporate management. So the system that is in place to run businesses should be in the best interest of the shareholders and the stakeholders, meaning the directors must act ethically at all times. So see, now the ownership of the company is with the shareholders, whereas they delegate control to directors. And so directors control the activities of the business. So company is owned by one party, whereas the affairs are run by another party. So then when you have two key people here, both of their objectives should be one and the same. And the issue is when it is not. For example, shareholders, they would want the highest return for the amount of risk that they take. And they would expect directors to act in the best interest of their objectives. But sometimes they don't. That's when the issue is. So corporate governance focuses on telling the directors, look, this is how you need to do things around, so that you protect the interest of the owners, namely the shareholders. Right, now the agency theory, it's about the relationship between the shareholders and the directors. Shareholders are known as the principal, and they appoint directors as agents to run the affairs of the business. So directors are accountable to the shareholders, and directors should perform the activities, the tasks to manage the company in the best interest of the shareholders. Think of it something like this. You invest money and you appoint someone to do business activities on your behalf. How would you want them to act or perform things on your behalf? You would want them to be trustworthy. You would want them to make the right decisions. You would not want them to take excessive risk. You would want them to make sufficient returns and give it back to you. You would want them to return your investments. So you would expect them to act in the best interest of you. So it is tricky because sometimes directors they don't do that. Right, so agency accountability is about acting in the shareholders' interest, providing good information, truthful information, and also operating within the legal structure. Just because the directors are supposed to maximize return to shareholders, they cannot go out of the boundaries or break the rules or break ethical guidelines. You must always be within the legal structure, the ethical guidelines, right? There's always a scope within which the agents or the director should operate to give what shareholders want in return. Right, now governance approaches mainly of two types. One is rules based and the other one is principles based. We will also look at ownership models and convergence of governance codes. Now, when you say rules based, especially in US, it is more of a legal requirement for you to follow certain best practices. Whereas in the UK, you are expected to be good or perform things in the right way. So these rules, for example, in US, comes through the stock exchange, company law, etc. Whereas in UK, they come through organizations that work towards best practices, which are formed by companies coming together or which are laid down by the stock exchanges. But they are not rules, they are principles. I will be sharing notes tomorrow for you to go through in detail on these areas, how it works, etc. Right, in favor of rules-based approach, from the organization's perspective, you as a company, you know what exactly is required from your end, or what are you supposed to comply with. For instance, the rules-based approach would say you must submit quarterly accounts. So it's laid down in the rule. So everyone will know what needs to be done. So when they want you to file quarterly accounts, you can't do biannually because it's clearly laid down. So clarity of requirements are there. Also standardization. I mean, it's equal standard across all the companies. And also binding requirements you must do. And in terms of wider stakeholder perspective, it is good for everyone as the standardization across all companies. And if you don't follow, there can be sanctions and also greater confidence in compliance. The investor confidence will increase because they know the framework is protected by law. So the trust and the confidence will be enhanced in the system. Against rule-based, see, rules can't cover every areas, every aspects. So there can be exploitation of loopholes, and environment keeps on changing. So new things, innovation comes up, and then your existing rules may not capture or cover those aspects. So then the agents, they might find loopholes to get away. Also the underlying belief that it's tough and you don't have much flexibility because you need to comply, and a bit of bureaucracy, checklist, can do 1 to 10 and then you're okay. You don't need to do anything else to be a good corporate citizen. And in terms of wider stakeholder perspective, some view it as too much of regulation. Also, there is cost involved, especially legal cost, and it puts certain limits and you cannot spread your wings as you want. And again, box ticking. Just complying to what the rules say, and basically you stick to the minimum legal requirement and you wouldn't want to do something beyond. So those are the rules against, factors against the rules based approach. And when it comes to stakeholders and social responsibility, this is quite an important area, especially when it comes to case studies, because it's a high level factor. Stakeholders are people who can affect the affairs of a business and who in turn can be affected by the affairs of a business. So they are connected parties. And there are various types like customers, employees, tax authorities, suppliers. So there are so many. So then as a company, as a corporate, we should know how to handle them, because you can't antagonize your stakeholders and operate. If you don't give a good quality product or service to your customer, they are not going to buy from you. You treat one customer bad and he's going to go talk around. And then in today's context, social media is very powerful. They just go and put a status update so the whole country or the world gets to know what's going on. So we need to manage them carefully. But the problem is there are so many stakeholders, we don't have much time and resource to manage them. So we need to identify whom do you focus on, where do you spend most of your time. So how do you manage these guys? And then CSR, corporate social responsibility. So let me move forward. So CSR refers to organizations considering and managing their impact on variety of stakeholders. So a company's responsibility towards society. A company's responsibility towards society. So CSR is all about doing good to society, or it can be said as providing more than the legal minimum. Providing more than the legal minimum. There are arguments for and against CSR. There are arguments for and against CSR. Some argue that by providing a good quality product or service itself, a company is acting in the best interest of the society, because customers transfer price for which companies transfer value through a product or service. So long as this product or service matches customer expectations, then their CSR ends at that point. While some others argue, no, companies should do more than that. Something like doing a charity, going out of their ways to help society. So it's arguable. But the concluding point is that CSR would bring in long-term value to the company. You look after the society, you build a good image for your company. So then this company would attract socially conscious investors. People would like to work for your company. So you can attract, high skilled employees, and they will not want to leave you because you are doing things in the right way, ethically, and in the best interest of the society as well, along with protecting the interest of the shareholders. So CSR makes you a good corporate citizen. So though it is sometimes considered as an expense item, the effect is long term in terms of positive returns. So Carroll defined CSR as including 4 points: economic responsibility, that is your responsibility towards shareholders to make money, sufficient returns; legal responsibility, work within the framework; ethical responsibility; and also philanthropic. Like I said before, going out of your way, or doing charity, doing more than what is required. There are companies in real life that work for social causes known as social business. They manufacture a product, they sell, but they sell it at cost. And whatever the money they earn, they don't take it back. They just keep it to run the business and make sure that their social cause is completed. So that's basically the philanthropic responsibility. Right, so CSR strategy. Now, there are two things. One is CSR strategy, and the other is strategic CSR. CSR strategy and strategic CSR. So CSR strategy is about identifying stakeholders, classifying, grouping them into various baskets, identifying what they want, stakeholder claims, and assess their importance. How important are they to you, and to what extent you must protect them, listen to them, etc., and decide on response to social pressure. So any strategy is about utilizing resources in order to achieve a particular objective. So when it comes to CSR strategy, listen carefully, you allocate resources on planned activities of CSR. So that is what CSR strategy is. Can you think what strategic CSR is all about? CSR strategy is using your allocated resources on identified CSR projects. Using your allocated resources, it can be money, men, material, any organizational resource. So whatever that you have allocated for CSR, Using that resource, you carry out your planned CSR projects. That is CSR strategy. Can you tell me what strategic CSR would be? What do you think that is? Anyone wants to answer that? Right, so strategic CSR is about a company doing CSR activities that will benefit them back. For example, let's say you're a hospital, a profit-oriented business, a profit-oriented hospital. So you go and set up a nursing school in a remote village for people who would like to become nurses, who are poor and who cannot afford. So this free school, nursing school, will produce good nurses whom you can employ to your organization. So what happens is you are doing something good to society or a section of the crowd, and from that crowd now you can pick good output in terms of good nurses for the benefit of your hospital. So that is what strategic CSR is. It's more focused than CSR strategy. So as a business, you must focus on strategic CSR, right? That is, the money you spend today will benefit society plus you in future, rather than focusing on ad hoc activities. So that's the strategic CSR is all about. So I hope you understand clearly the difference between CSR strategy and strategic CSR. So as businesses, we must be more focused on strategic CSR. So whatever the monies we spend, it comes back to us in some form, while benefiting the society as well. Right, stakeholder theory is any person or group that can affect or be affected by policies and activities of an organization. And stakeholders, these are the demands, a stakeholder claims that these are the demands that stakeholders make of an organization. They essentially want something from an organization. Customers want good quality products and services. Employees want conducive working environment and good pay. Shareholders want dividends and capital gains, returns. And then inland revenue departments, tax authorities want you to pay the taxes on time. So different stakeholders have different claims on the organization. And then there are so many types: direct stakeholders, indirect, active, passive, right? But we don't need to go into those details, but in general, who are the stakeholders and what their claims would suffice. Right now, this is a very important model that is used to manage stakeholders. This is known as the Mendelow's matrix. Now, according to Mendelow, the management of stakeholder will be based on two key factors. One is the level of interest that a stakeholder has in your organizational activities. And the other is the level of power. Level of power means to what extent can they influence your decisions or your activities. So low power and high power, and low interest and high interest. If a particular, now how you use this model is, first you identify the stakeholders who are pretty much connected to your organization, and then you try to place them in one of the quadrants, and then we decide what we need, what we should do with each of these different types of stakeholders. So for example, there is a category or type of stakeholder whose level of interest is low and their power is also low, meaning they are not that worried as to what's happening inside. They don't want to know, and they can't, or they don't have much power to influence your decisions as well. So then we say ignore them. According to Mendelov, we say you put minimal effort in managing them. Don't bother. Don't waste your time and resources for people who fall into this quadrant because they cannot do much and they are not bothered. And with stakeholders whose level of interest are very high, meaning they want to know what's happening inside, they want you to tell them constantly or update them, and also their level of power is high, meaning they are influential. They can do things to adjust the decisions. So these stakeholders are known as key players. So how do we tackle these guys? You must constantly update as to what you are doing, your future strategies and ongoing progress, etc. Also, you must give them what they want. For example, high skilled employees, their level of power is high because if they leave, the technical know-how, all that is gone. And they will also want to know how the company is going to look after them in the future. So you need to give them a sizable package so that they are happy, and set a clear career path for them to grow in their chosen career lines. So that's how you manage a key player. So you have to put a bit of time and resource here in this quadrant because they are with high level of interest and power. And if you look at this quadrant, that is where a particular stakeholder has high level of interest, but their level of power is low. So now what do we do with these guys? We say keep informed, meaning you update them constantly as to what your future strategies and the ongoing progress is. Then they will be happy. And on the other side, another category of stakeholders whose level of interest is low, but their level of power is high. Okay, they don't want to know what's happening inside, but they can influence things. So then you keep them satisfied, meaning give them what they want. You don't have to tell them what's happening. So you identify different types of stakeholders. Depending on their level of power and interest, put them into a particular quadrant and then manage them accordingly. One important thing that you must note down is that when a particular stakeholder belongs into this category, for example, minimal effort, Keep them there and manage. Don't let them move to other quadrants. Or someone who is in this quadrant as keep informed, keep him there. Don't let him move to key players quadrant. Now let's say, okay, keep satisfied. Their level of interest is low, power is high. Meaning they don't want to know what's happening, but they want something from you, so you have to give them what they want. If you don't give them, their level of interest will increase and they will start moving from this to this quadrant and they become key players. They will become influential. For example, let's say a category of labor in your organization, they are facing some difficulties and you are not listening to their concerns. Now what they'll do is they will join the labor union and they will try to gain support. So if they were, for example, in keep informed or keep satisfied quadrant, with the help of the labor union, their level of power or interest will become high and they will move here, key players. Then it will become difficult for the company to manage. So keep them where they are and manage. Do not let them move around the quadrants and especially move to this area where it is, difficult to manage, key players. So stakeholder management is a very important area when it comes to case studies because we are dealing with people. And in the exam will paragraphs will highlight a level of power and interest of different types of stakeholders. But if there are confusions as to their level of power and interest, you can always argue within the scope. For instance, skilled employee category. You can fairly assume that their level of interest and power is high and then they should be key players. And unskilled employees will normally, fall under the minimal effort category. If they can't join with any other employee category, yes, they will be there at minimal effort. But if they have the ability to join with a trade union or even with any other categories of employees, they will gain more power and then therefore they will start moving quadrants. So you can argue depending on how the scenario develops and what it mentions. There is room for you to argue within the scope. Right, someone wants me to summarize strategic CSR and CSR strategy. So CSR strategy is about carrying out CSR activities on a planned order using the allocated resources. Whereas strategic CSR is carrying out CSR activities which will benefit you back in the long term. So a company should be more focused on strategic CSR because the money they spend on CSR activities will benefit them back in future. Also another question, then meaning that CSR should be part of the organization's strategy. Definitely. CSR should be part of the strategy. It should not be something that you decide later and plug in. It should be within your overall strategy. But this is another important topic area in your syllabus. Effect leadership. I would like to start with a question. Are leaders born or made? What do you think? Leaders, are they born or made? I would like to get some quick answers. Right, I'm getting interesting answers. Some say born, some say made, some say both. Right, now I will modify the question a bit. You have organizational leaders, we call them managers. And then there are inspirational leaders. I am talking about inspirational leaders. I mean, you look at, for example, Nelson Mandela or Imran Khan or Mahatma Gandhi. These people, are they born or made? What do you think? Right, some say born, again, some say made, but I got a good answer. One student says the situation made them leaders and they adapted well. They are leaders because of certain circumstances surrounding them. Yes. These great, I mean, leadership is is a special ability to lead people, inspire people. So these, see, normally the leaders are put into three baskets. One, bad leaders, then we have the good leaders, and then you have the great leaders. So the leaders that I'm talking about is the great leaders who are made because of a particular situation. There are a lot of theories, a lot of arguments as to how leaders evolve. But generally, a situation would make an inspirational leader when a larger crowd cannot do things on their own, they appoint someone to derive things on their behalf. So that is one way. Or due to some incident or a situation, someone could emerge as a leader. So born leaders are normally the kings, we are not talking about them. So a real leader is someone who can inspire. Right? One World War veteran said, if you want your men to build a ship, teach them the desire to the sea, meaning motivate them. Show them the benefits or the end result, then your people will automatically do what needs to be done. The point here is managers who are appointed by the hierarchy should act as good leaders. It's not that you try to follow bureaucratic, practices in leading your, employees. They will do the work, but there won't be much motivation. So if you want to get the best out of your employees, you must inspire them. Then they will go that extra mile to perform better for the benefit of the organization. Right, so leadership is an interpersonal influence directed toward the achievement of a goal. Interpersonal means between people, thus a leader has more than one person or a group to lead. Influence is the power to affect. You move things, your actions, your speech, your activities, move things. And goal or the objective is the end one strives to attain. So basically, your target. So leadership can be viewed from three standpoints. Now these are theoretical areas, that is from an attribute or a position. So like I said, given by the hierarchy, given by the organization, the designation, the managing director. Someone can have the designation, but they may not have the real qualities that are required to become an inspirational leader. That's where the problem is. I mean, as leaders, even appointed in organizations, you must try to be inspirational leaders, not just someone carrying a label. Also, leadership can be viewed from the point of view of as a characteristic of a person, a natural leader. This is what I'm more focusing on, natural leader, based on the characteristics, and also category of behavior, which is based on behavioral theory or traits theory. Great leaders were considered to have, for example, physical traits such as drive, energy, appearance, and height. I mean, there are leaders, with good personality. When you see them, you have a lot of confidence in them, you listen to them, etc. Personality traits such as adaptability, enthusiasm, and self-confidence. So self-confidence, is pretty much high on them. They will somehow achieve things on their own. Social traits such as cooperation, tact, courtesy, and administrative ability. Ability to work with a larger crowd. Above average intelligence. Their ability to see things that average people cannot. Also, ability to initiate, motivate, self-assurance, and self-confidence, and also the helicopter factor. Something like having a bird's eye view, or the ability to rise above the particulars of a situation and perceive it in relation to the surrounding context. Working for the benefit of the whole. And other essential qualities included enthusiasm, social ability, integrity, courage, etc. Those are good habits that the great leaders would have. So one way to look at great leaders is from the point of view of trait theories. Behavioral or style theories talks about 4 different types. A successful leader will exhibit a pattern of behavior, that is a particular style. So the first one is autocratic, tells. They don't listen, they don't consult, they just tell what needs to be done. And you can't negotiate, you can't consult. So it's more bureaucracy. Or sells. So a leader who sells will persuade, give you the benefits of what you are doing, try a little bit of motivation because he's trying to convince you. Or consults. participative. Gets your opinion as well. Let you suggest. And finally, the democratic, outcome from the larger crowd. I would like to throw a question now. Of the behavioral styles, the 4 styles, which is the most appropriate one? Which style of leadership is more suitable to run a business? Right, so there are a lot of individual answers, like some say democratic, some say participative. But this is also more situational in the sense a democratic system or the system of joints style, the style of joints would work when your followers are educated. If I ask you whether you want black or white, your answer should be based on the benefits of black or white. It's not because of it. It's not because whether you like black or white. So that's the tricky part when it comes to democracy. The followers should have the necessary expertise or the skills to decide what is best for everyone. So if you're dealing with your skilled employees on a particular matter, then the joints style is more appropriate because skilled employees, they will evaluate, look at positives, negatives, advantages, disadvantages, etc., and then tell you what's best. Similarly, if you're talking to unskilled employees, trying to do something with them, will democracy work? To a great extent, no, because they will not have the ability to evaluate. So in that situation, it's more of tells or sells. So with difficult employees, it's okay to be autocratic because you want to get the job done, and they don't have the necessary skills or knowledge to tackle the matters. So what style is suitable will depend largely on the situation and the people whom you're dealing with. Right, so the next leadership style is the contingency or the contextual theory that says style theories ignore the important influence of the context in which the leader is operating, the situation. But there is no one best style of leadership that is equally effective for all circumstances. A mixture of both trait and contingency is the situational approach. Right, so contingency says a leader should act according to the situation. So if the leader has the ability to understand, and if he is dealing with skilled employees, he would take a particular approach. If he's dealing with unskilled employees, he would take a particular approach. When he's dealing in boom, he will take a particular approach, and when he is dealing during recession, he will take a different approach. So that's what contingency talks about. Right, leadership and management. Management is the process of setting and achieving the goals of the organization. Management has 4 elements. That is planning, organizing, leading, and controlling. Planning, organizing, leading, and controlling organizational resources to achieve the goals and objectives of the organization. So management is about 4 things, whereas leadership deals with the interpersonal aspects of manager's job. All leaders can be managers, but a manager is not necessarily a leader. Like I said before, leadership is your ability to inspire. Not all managers can do that, because manager is a label that can be given by the organization. Sometimes you are very good in finance, and then company will appoint you as a finance manager, and then you will have subordinates working under you. Now your position was given to you based on your skill of doing a particular task, accountancy or finance. That does not mean you are good in managing people. So as a good manager, you must also be a good leader. That's when you get the best out of your people, right? So look at this point, differentiating between leadership and management. Employees willingly follow leaders because they want to, not because they have to. So when it comes to a leader, people will be willing to follow him. But when it comes to a manager, the subordinates will listen to the manager because they're supposed to. The willingness may not be there. So especially budding professionals, it's very important that you try to be good leaders. Then the management part becomes very easy. Right, moving on. Leadership and culture. There are 2 types of leaders, again further classifications. Transactional leaders and transformational leaders. Transactional leaders tend to be more passive. They see their relationship with their followers in terms of a trade. So your boss, let's say, is a finance manager, and he tells you to do monthly accounts. So that is, he wants you to complete a particular task. That is known as a transactional leadership. Whereas in another instance, your boss is a finance manager. Of course, he gives you tasks to finish, but then he inspires you, he motivates you to study further. He helps you in whatever the ways he can. Depending on how the future moves, he gives you advice for the benefit of you, for the benefit of the organization. Right now, those are transformational leaders who are more proactive. They are not reactive. So they see their role as inspiring and motivating others to work at levels beyond mere compliance. So someone tells you to do something and it stops there, that is transaction. Someone identifies that you have further abilities and motivates you, advises you, helps you to work on those, then they become more a transformational leader category. And this is where we should try to build ourselves or work on transformational leader category. Further categories are entrepreneur and intrapreneur. Entrepreneur, we already know, is an individual that starts up a business, is the owner and take all of the risks of financial loss. Right? Entrepreneur, one man show, put it in easy words. Intrapreneur, not a new concept, it has been there, but now it's getting to the textbooks. Intrapreneur is an employee of the company and does not usually have any ownership and minimum risk of financial loss. Basically, let's say you're working for a company in the production department, but management has seen certain abilities in you where you can run a business on your own. So now the company will invest and they will let you run a subdivision or another business under the same umbrella, and you will become the boss of that particular division or the unit. So you are still part of the bigger company, and but you are an entrepreneur inside. So we call that an intrapreneur. Right, is an employee of the company and does not usually have any ownership and minimum risk of financial loss. So in case if things go wrong and the company that you're heading makes losses, okay, you will not bear it. Right, but this is a area where the senior management identifies employees with special skills, entrepreneurship skills, and they invest on them. Right, so I would like to quickly run through this question, that is leadership. I hope all of you can download. I would give you about 8 minutes to quickly read the leadership question, starting now. Right, I hope you have done reading the question. Let me read the requirements for you. You work as a member of the 100-day reviews team at SCAT. Prepare a brief report for the SCAT HR director to explain why the change of leadership style at ARC was unsuccessful and whether this reflects a poor approach to SCAT's management training program. Professional skills marks will be awarded for demonstrating commercial acumen in demonstrating awareness of the wider external factors that may have affected the success of ST's new management style. Right, few things I would like to highlight. First of all, the format of the answer. If you have a hard copy, I would like you to underline, or even on your machine, the report. So first thing you must notice that the answer should be provided in the format of a report. So when it comes to a report, when you write the answer, you must put a topic or heading to say that report on management style at ARC. And then you should say to whom. So you have to. It should be HR director, SCAT. And then from. So you can say a member of 100-day review team. And then you must also put a date. So when you do the exam, it can be the exam date. And also subject, a heading. So in this, I mean, a simple small heading. You don't have to, write 2-3 lines of heading. It can be just one line. So in this case, it can be the reasons for leadership failure at ARC and the effect of SCAT's management training program. A simple subject, a heading. So immediately after this to, from, subject and date, you must have an introductory paragraph. In an introductory paragraph, you introduce what you are going to write about. Again, it should not be a lengthy introduction. It could be for maximum about 5 lines, maximum. So what you would say is you are discussing why the leadership style at ARC was unsuccessful and whether it reflected a poor approach to SCAT's management training program. A simple introduction. And then you would break your answers into 2 parts or 2 sections. So below introduction, your first section and the heading would be management style at ARC. And then the second part of your answer can be the impact of SCAT's training program. So structure to answer is very important in SBL because a lot of professional work is expected. So planning is also important as to how you plan and then implement in your answer. Right now, what is commercial acumen? Because we have professional skills to capture, marks for professional skills. So in this case, it's about demonstrating commercial acumen. So commercial acumen is about business awareness. So in answering this question, you must touch on the business aspects. For example, if the leader is absent, how will it affect the business? If the leader makes wrong decisions, how will it affect the business? How will it affect the employees? And because of that, what are the business implications? Right. So first question for you, from all of you. Okay, someone asks, can you tell us on how to plan answers? So I've already told you. Bring in a structure to answer. So this question has two parts. One is why the the leadership style was unsuccessful, and the impact of the training program. So you break your answers into two parts. So in the first part, you discuss the reasons as to why the leadership style was unsuccessful. Now my first question to is, what kind of leadership style or category or behavior will you say that this particular leader showcases? What is the style that he is adopting? Right, very good. So at the beginning, he was more of an autocratic leader. So, and another way of looking at it is he was more of a transactional leader. He had his own conceptions to say that people are lazy. They have to be told what need to be done. Right? He never consulted anyone. So this is real life. This is how even in real life people are. So in answering, you must start with mentioning the style, and then you reason it. For instance, you can say, prior to attending the course, Sully, the leader, was more of an autocratic leader. Why? Because of 1, 2, 3 reasons. Or he was a transactional leader. Why? Because of 1, 2, 3 reasons. Right? He thinks the employees are lazy, they don't know what to do, they need to be told. So you give the reasons. And he is more worried about completion of a task, and he would do everything by himself, and then it's just a matter of telling the employees what needs to be done. They don't have any space to think and act on their own, because every direction comes from the leader. So post training or the acquisition, he attends the 100 this rather he attends the training program. Then according to the training program, they tell them employees should be empowered and enriched, jobs enriched. So he gets back to office, and he becomes more relaxed. What kind of leadership style he showed after the training? Yes, so after the training, he became more of a democratic leader. Right, the main influence was the training program. So in answering this part of the question, so you would say, soon after the training, Solly promoted more of a democratic style, where leadership responsibilities were shared with subordinates, who are also involved in planning of tasks. not their execution. So the course made him to change. So he was more autocratic and now he is more democratic. But see, his kind of the kind of business that he is in is more routine work. Of course, there's about say 20 to 30 percent of factors that change on a daily basis, but it's quite more routine. So it is easy for you to manage when you have laid down clear guidelines. And then whenever there is a contingency or an unexpected event occur, you empower your people to make decisions for smooth functioning of the business. So that's where we bring in the commercial acumen part. Right? So all these days, I mean, prior to the training, he had people gotten used to his style of leadership, where they listen to him and then execute, implement what he says, and then they are comfortable. But now after the training, he comes and empowers, and now they find it difficult because they don't have the experience in doing things on their own. And now what happens? They become confused and anxious, and they themselves want the leader to go back to his old style of leadership, meaning a task oriented leader or a transactional leader. So now the second part of the question is, where's the problem? Is it a style of leadership, or the question says whether this reflects a poor approach to SCAT's management training program? So is there a problem with the training program in what they told their participants? What do you think? If you can give me a few points as to where the problem is. See, what I want you to understand is these kind of questions you can argue and make your point by giving justifications within the scope, of course. See, in answering these questions, you must bring in more and more points to justify your claim. That's how you collect your marks. So, for instance, in this case, the reasons for failure or the issues with the training program. One is speed of change, right? Good 10-15 years you're used to one method of or one way of working. Suddenly your boss goes on a particular training, he comes back and says, okay, now shift gears and do things in a different way. People will not be able to adapt, right? So the culture is different, so there needs to be change management. We can't expect people to change overnight. People dynamics need to be understood, and then things need to be put in place for change management. So that is one. Speed of change. Number two, the leader's confidence. Now, he did not realize that he had not trained employees who can make decisions on their own. All his life, he had told what they need to do. He never empowered them. He never got them to think on their own and carry out things. So his level of confidence or his understanding was weak. And the training program did not understand his mindset. It's like this told the leader, you go and do this. But they did not do a diagnosis. They did not understand what's going on before. So it should have been based on what kind of leadership that has been carried out in the past. And accordingly, the training program should have suggested a methodology, including change management. Another factor is the employees were not ready or not willing to accept the new style of leadership because they are not used to. They haven't made any decisions in the past. They haven't acted as leaders themselves. So it was a big problem for them, and then things got delayed, took a lot of time, and they made a lot of mistakes. So these are the results of wrong leadership. So the training program should have looked at the previous leadership style, and accordingly they should have advised, suggested a more appropriate approach. Leadership styles can change, but it should look at how it has been in the past. That is important. Yes, and someone suggests that change should be gradual, especially in this case, where employees are used to working on a particular style for a long period. Yes, it has to be slow and gradual. Should Sully explain to employees that it's okay to make mistakes and they will learn from their mistakes? Yes. Yes, with the answers that are coming in, I can, say that you're pretty much in line with the kind of thinking that is needed to answer a particular question. So that is really good. So I hope you got some idea as to how to tackle a theoretical question like this. It's all about doing more and more practice questions of this nature to get the hang of it. Like I said, yesterday, it's more of a skill in handling these questions. Right. So moving on to board of directors, which again is part of leadership because directors are the leaders for the organization. They sit at the top or at the strategic level, setting the vision, mission, and the direction for the business. So we need to look at how do we select them, what kind of expertise they should have, where do these guys come from, how do we supervise them, and many other aspects, the composition, the roles and responsibilities, and executive directors and non-executive directors, single and two-tier or unitary and two-tier structure. So quite a bit to look at. So what I would do now is take a break and then come back exactly in 15 minutes. Thank you. All right, welcome back. So let's start with the board of directors. Right, so according to UK CG code, the roles and responsibilities of directors is to provide entrepreneurial leadership of the company and represent company view and account to the public, decide on a formal schedule of matters to be reserved for board decision, determine company's mission and purpose, select and appoint CEO, chairman and the board members, and set the company's values and standards. So it's not necessary that you by heart and remember all of this, but on a generic note, you must know what the director's roles and responsibilities are. Moving on, ensure that company's management is performing its job correctly. That is in the best interest of the shareholders. Establish appropriate internal controls so that risks are managed and mitigated. Ensure that the necessary financial and human resources are in place for the company to meet its objectives. Basically, keep resources in place. Ensure that its obligation to its shareholders and other stakeholders are understood and met. So then they must be constantly in touch with the key stakeholders and also meet regularly to discharge its duties effectively. So that's about the board meeting. For listed companies, that is companies listed on the stock exchange, appoint appropriate non-executive directors. So directors are of two types. One is executive directors, who are full-time directors, looking after the affairs of the business or running of the business. And then we have the non-executive directors category, who's there to look after the work of executive directors. Because if there is no party to look after the work of executive directors, they might decide their own salary. So the pay pack can be really huge. And there can be a lot of conflicts, meaning they might not act in the best interest of the shareholders. So to avoid that, an NED category is there to supervise the executive category. Also establish remuneration committee that looks after the remuneration of directors. Nominations committee that exists to appoint directors. Audit committee, and assess its own performance and report it annually to shareholders. And also submit themselves for re-election at regular intervals. Meaning, a director cannot be director in a company for 10, 20, 30 years. They should put themselves for election. So if their performance has been good, they will get re-elected to the position. Potential problems for boards. Rely on management to report information to them, allowing problems to be obscured. Also, board that meets only occasionally may be unfamiliar with each other. This can make it difficult for board members to question management, meaning if they meet rarely or occasionally, they don't know the people, they don't know what's going on, so it's difficult for them to question or identify what's going on. Also, CEO's forceful personality is exercising too much influence over the rest of the board. Sometimes the CEO, the chief executive officer, he takes an upper hand and then override decisions. So that can be a problem. Also, CEO's performance is judged by the same directors who appointed him or her, making it difficult for an unbiased evaluation. So these are real life problems for boards. Right, now the board structure, it can be a unitary board or a two-tier board. In a two-tier board, like I told you before, You have one set of directors to manage the business, and you call them the management board. And then there's another set of directors who will supervise. So that is non-executive directors supervising the work of executive directors. In a unitary or single board, we will have executive and NEDs together. So lower tier in a two-tier structure, management board responsible for day-to-day running of the enterprise generally only includes executives, executive directors, and the CEO coordinates activity. So CEO will make decisions and consult the other executive directors, and then will coordinate activities with the director board and the functional heads, that is, or departmental heads. And the upper tier or the supervisory board appoints supervisors and advises members of the management board, and they also provide the strategic oversight. It includes employee representatives, environmental groups, and other stakeholders, management representatives. And these NEDs or non-executive directors are not considered to be independent NEDs. The chairman coordinates the work, and members are elected by shareholders at the AGM and receives information and reports from the management board. So advantages of two-tier board: clear separation, that is, who is doing the work and who is supervising. Implicit shareholder involvement via NEDs, and wider stakeholder involvement, that is because there's representation from employees, environmental groups, etc. And independence of thought, discussion, and decision. It's not one party or one set of crowd who makes the decisions. And direct power over management, which is very important for good conduct of business affairs. Problems are dilution of power, isolation of supervisory board. Sometimes they try to become too strong because they are another set of crowd. Agency problems between the boards because of objectives, bureaucracy, and reliant upon relationship between chairman and CEO. One question: can the chairman and CEO be the same person? Can the chairman and the CEO be the same person? In a private firm, yes, but not in a listed company. And that's not good governance. Chairman should be separate from the CEO. It should be two people. Right, so most of you are in line, so that's good. Right, reasons for independence of NEDs. So this is important: to provide a detached and objective view of board decisions, to provide expertise and communicate effectively. So it's important that NEDs, composition of NEDs should be from different backgrounds. Of course, executive directors as well. But since they are in a supervisory role, plus providing expertise, they should have proper backgrounds. Also, to provide shareholders with an independent voice on the board. Right, so they should be independent and be able to tell the shareholders what exactly is going on. Also, to provide confidence in CG and to reduce accusations of self-interest in the behavior of executives. Threats to independence of NEDs. The independence of NEDs will not be there if these factors are in existence. For example, material business relationship in last 3 years. Say for example, one of the NEDs has a company, and through that they supply to the company where this NED is functioning as an NED. So then he will be biased towards this company. Then, and he was an employee in the last 5 years, meaning biasness will exist. Cross directorship in other companies. Can you tell me what cross directorship is? What is cross directorship? What exactly is cross directorship? And why is it a threat to independence? All right, it is something like this. You are a non-executive director in a company where your brother is an executive director. And in this company, you are executive director and your brother is a non-executive director. So what happens is, in the company where you are the executive director, your brother is in the supervisory board. And in the company where your brother is an executive director, you are in the supervisory board. So both of you will have biasness. He will try to protect you because you are a supervisory, and you will try to protect him because he is a supervisory. And so it's one of the major threats to independence. So such situations should be avoided. Remuneration from the apart from those remuneration from the company besides directors' fees, maybe additional consultancy, etc. Close family ties, significant shareholding or shareholder, or serves on board for more than 9 years. So complacency kicks in, and you will take things as granted, and there won't be independence. So these are some of the factors that will pose a threat to independence of NEDs. Right. So chairman and CEO, there should be a clear division of responsibilities must exist at the head of the company, and no individual should have unfettered power of decision. So responsibility of the chairman is to ensure that board sets and implements the company's direction and strategy effectively. So chairman should make sure that it happens and acts as the company's lead representative, that is provide leadership explaining aims and policies to the shareholders. So normally chairman should be someone who's experienced, a personality with a number of years of corporate experience. CEO, on the other hand, take responsibility for the performance of the company as determined by the board strategy, and also report to the chairman and of the board of directors. So CEO, in consultation with the board, take responsibility and implement what is planned, and then he will report back to the chairman and the board as to how the company performs. Right, board committees. So there are 4 committees that you must know about: nominations, remuneration, risk, and audit. And these committees are formed by the board of directors. So importance: reduces board workload and enables them to improve focus on other issues. You can't get all the directors to work on everything. So what happens is we form committees within, and then assign different tasks like remuneration, audit, etc. Also create structures that can use inherent expertise to improve decisions in key areas. So if 2 of the directors are experienced in audit work, so the audit committee can be formed using them, something like that. Communicates to shareholders that directors take these issues seriously, increase in shareholder confidence, and also communicates to stakeholders the importance of remuneration and risk, etc. Satisfy requirements of UKCG code. Right, nominations committee. Now their role is to provide a formal, rigorous and transparent procedure for appointment of new directors to the board. So that's what the nominations committee do. They work on appointing new directors to the board as and when needed. So responsibilities review regularly the structure, size and composition of the board and make recommendations to the board. There is no hard and fast rule to say this many directors should be there in a particular board, but it will depend on the organizational size and requirement, etc. So the nomination committee has the responsibility to identify and then decide the size. Consider the balance between executives and NEDs on the board of directors. Question: let's say the board of directors are 10. How many should be executive directors and how many should be non-executive directors? If there are 10 directors in a board, how many of them should be executive directors and how many of them should be non-executive directors? Anyone who would like to answer? If a board consists of 10 directors, how many of them should be executive directors and how many should be non-executive? Yes, it should be 50-50, equal balance. Right, also ensure appropriate management of diversity to board composition. Now this is also very important. Ensure appropriate management of diversity to board composition. And provide an appropriate balance of power to reduce nomination in executive selection by the CEO or chairman. Also, they have to make sure that the directors are from different backgrounds. So you have a fine blend. If you appoint all directors who are from financial background, they will not look at other aspects. Or you can't have all directors from sales background. So you must have directors, individual directors from different backgrounds, so that all aspects related to the business can be discussed and covered appropriately. So further responsibilities: evaluate the balance of skills, knowledge. This I already mentioned to you. Full consideration to succession planning for directors, right? Continuation. Prepare a description of the roles and capabilities required for any particular board appointment, including that of chairman, and identify and nominate for the approval by the board candidates to fill board vacancies as and when they arise. Recommendations to the board concerning the standing for reappointment of directors, and be seen to operate independently for the benefit of shareholders. So this is very important role of nominations committee, to be independent and act on behalf of shareholders. Remuneration committee, and their role is to have an appropriate reward policy that attracts, retains, and motivates directors to achieve the long-term interest of shareholders. So if you don't have a remuneration committee, the directors will start deciding their own salaries. So that will become a problem for shareholders and for the company. So the committee will look after what needs to be paid, and how much should be paid to attract good caliber directors to the board. Objectives: the committee is and is seen to be independent with access to its own external advisor consultants, has a clear policy on remuneration, and performance packages produced are aligned with long-term shareholder interest and have challenging targets. As directors are the key leaders, or people vested with running the business, they also have targets. And reporting is a clear, concise view of policy payments and the rationale behind them. Why did you decide to pay this much, and what kind of rewards, etc., should be supported by a rationale. Also determine and regularly review the framework, broad policy and specific terms for the remuneration, terms and conditions of employment of the chairman, board and executive directors, including design of targets and any bonus scheme payments. And also recommend and monitor the level and structure of the remuneration of senior managers, and establish pension provision policy for all board members. See detailed remuneration for all executive directors and chairman, set rather, and ensure that the executive directors and key management are fairly rewarded, because any rewards that are lesser than market rates or whatever will demotivate them, and then you might lose good quality leaders. The remuneration of the executive directors and key management is set by individuals with no personal interest. Right, so that's where the independence is also a key factor. Agree any compensation for loss of office of any executive director. Right, in this we have two more committees. One is the risk committee and the audit committee. So the audit committee looks after the appointment of auditors and the audit work. Risk committee is a committee that is responsible for internal control and make sure that the company puts in place strategies to mitigate or eliminate risks that the company faces. Because risk, okay, I will touch on it later, but then these two committees are also equally important committees as nominations and remuneration. Right now, I would like to turn your attention to the next question that goes as governance and committees. Can you take about 5 to 10 minutes and quickly read the question that goes as governance and committees? All right. The question goes as write a report to T criticizing the governance arrangements of R and company and assessing the usefulness of a nominations committee to the company. Few things to note: the format of your answer should be a report. So that is to, from, date and the subject and the introduction paragraph, and then the body of the answer with conclusions if required. And the professional skill that is needed here is skepticism. That is a questioning mindset or a probing mindset. For example, they say there are only 2 non-executive directors and 7 executive directors. So skepticism is like, how would this composition work for better CG? So it's that angle that you must take when you answer the question. Right, so now this particular requirement has 2 parts. Firstly, the current governance arrangement and what are the advantages or usefulness of a nominations committee. Can you write 5 criticisms of the current governance arrangement? If you can quickly write 5, just 2-3 words answer. Issues of governance in this particular company. Right, so I can see some good answers flowing in, but as I've always told you before, make sure that you have a nice structure when you write an answer. So the headings or the factors towards the criticisms of CG arrangement at R would be under these headings. One is non-executive directors. I would explain it a little slow so that if you want, you can take it down. First of all, the balance between executive and non-executive directors. Only 2, and then on the other side there are 7. So if anything comes for vote, it will be very difficult for the NEDs to make a winning situation. And with two NEDs, whether they will bring enough or sufficient scrutiny is a question, because it's 2 against 7. So this is where the probing element comes in, skepticism, right? Something, I mean, where you word it something like, it is doubtful whether 2 NEDs are enough to bring sufficient scrutiny to the executive board, right? And good CG, according to good CG, it's about having a 50-50. So this is in breach of such a requirement. Also, the independence of the current NEDs, because they were recruited from retired executive members of the board. So that again is another skepticism approach, right? Whether they will be independent. To a great extent, not. So when you write the answer, you look at it from a questioning mindset, probe. So that's what the skepticism part is. Always keep that in mind, the professional skill. The way you write, you will get the skill marks. I mean, you can conclude to say that there won't be independence, but it's the way you design your answer. When you recruit NEDs from retired executives, will they be independent? So that's the skepticism part. And they would presumably have relationship with existing executives going back many years. Would this, bring in independence? And also some CG like UK Corporate Governance Code specify that NED should not have worked for the company within the last 5 years, right? And then again, I mean, back again, this company R would be in breach of this provision, because these directors have worked for more than 5 years. Right, so the number 2 would be succession planning. That is continuity or appointment of directors. So in this scenario, it is based on the family members, rather than appointing from outside or appointing qualified individuals. Right, so a private company, without flotation, it's all right. But if you're a listed company, just because you have sizable shareholding doesn't, you cannot bring in your family members on a continuous basis. That is not good CG. And the moment you float, it introduces a need for external scrutiny as well. And the lack of NED, independence, would make this very difficult. They would not challenge. So not having sufficient NEDs is another problem here. Right, so one is they are not independent and they are not sizable in number, and they will not challenge these kind of practices. Number 3 would be the diversity. That is the background among board members. Normally, it is assumed that diversity would bring in conflict. But the benefit is that it would bring in perspectives or opinions from different aspects or different backgrounds, which is good for the company. If all are going to talk only about finance, that is not that great. So if there is a board which comprises of people from diverse background, and they are going to talk about all pestle factors, for example, then that is good for the company because you are covering or protecting the company from many different aspects. And the new addition is only the young blood for now. So experience is very important on the board. In addition, bringing in new board members with talent for future and with fresh ideas is also important. And number 4 would be strategic planning. According to the scenario, there is no discussion of strategy, and there is evidence of lack of preparation of strategic notes to the board, meaning they are not prepared for board meetings. No discussion of strategy, meaning direction, is absent. The assumption is that the best option is obvious, and so there is no need for discussion and debate. What worked for you yesterday will not work for you in future. So there should always be discussion and debate. Constructive debate. Procedures for preparing briefing notes on strategy for board meetings appear to be absent. That means they are not prepared. And according to most corporate governance codes, discussion and setting of strategy are high priorities. And again, this particular company is in breach of such a provision. And the 5th factor would be training and development. Normally, new directors should be inducted, and in this case, there is no evidence of training for the new director. And the training of new members and ongoing professional development of existing members is also an important component of good governance, because knowledge should be updated. Therefore, continuous professional development is important for the existing members. So a question with 18 marks. So I've discussed 5 areas. So under that you can bring in points, right? So that's how you capture the marks. So then moving on to the second part, the usefulness or the advantages or the benefits of nominations committee. Things that we already looked at in those slides as to what they do. I would quickly take you through the advice on the balance between executive and non-executive directors. That is establishing appropriate number type. And also note that nomination committee is usually made up of NEDs. Right? Nomination committee is only made up of NEDs. And they also establish the skills, knowledge, and experience possessed by the current board. Also, they, if there are any gaps, then they assist to fill by bringing in directors who have or who fulfill the requirements. Also, they act to meet the needs for continuity and succession planning. Also, they make sure there is a diverse, diversity of backgrounds. So in terms of this particular company, the nomination committee could address the following areas. Number one, how many directors would be needed to run the business, and also to plan for recruitment accordingly, right? Because their practice currently is different. Also to resolve the issues over number of NEDs. Then to resolve issues over the independence of NEDs, very important. And also to make recommendations over the succession of the chairmanship. Right, that is, it is not suitable for the family members to always, occupy senior positions. Right, anyone suitable should also be given an opportunity. Right, moving on. In terms of reporting, the integrated reporting part is also an important topic for your SBL. Normally, the annual report would consist of your P&L balance sheet and cash flow, and notes and changes in equity statement. Those are mandatory, must report. So in IR, integrated reporting talks about further reporting in simple terms. So let's see, let's get into the details. IR is seen by the International Integrated Reporting Council as a basis for a fundamental change in the way in which entities are managed and report to stakeholders. Purpose of IR? The primary purpose of an IR is to explain to providers of financial capital how an entity creates value over time. Unlike in traditional financial reports, in IR, we are going to reveal more information about a company's performance. That's the whole idea. Then you will be careful in terms of what you do and how you do. Right? See, an integrated report benefits all stakeholders interested in an entity's ability to create value over time, including employees, customers, suppliers, business partners, local communities, legislators, regulators, and policymakers. So your report is going to address a lot of stakeholders about how you are conducting your affairs. So if that's the case, you will be very careful as to where you source, what you source, how you transform them into final products or finished goods, and then how you deliver it to your customer. So it prompts you or pushes you to be a more sustainable business, also a more business that is concerned on society and other factors. So what is IR? Integrated reporting demonstrates the linkages between an organization's strategy, governance, and financial performance, and the social, environmental, and economic context within which it operates. So these are the two key things: social, environmental, and economic context within which it operates. Purpose: to help business to take more sustainable decisions. Right? You conduct business affairs, but make sure the environment is protected. Make sure the interest of the shareholders are protected. Make sure the interest of the employees are protected. Right? To assist investors and stakeholders to understand how an organization is really performing. So this is where you reveal a lot of information. Right? So format an IR should be a single report, which is the organization's primary report. So like I said, traditional annual report will have few financials, but now in IR we bring in a lot of other information. The objectives to improve the quality of information available to providers of financial capital. So they get a 360 view. To provide a more cohesive and efficient approach to corporate reporting that draws on different reporting strands and communicates the full range of factors that materially affect the ability of an organization to create value. Enhance accountability and stewardship. So that's another key objective for the board, for the broad base of capitals. So IR talks about financial, manufactured, intellectual, human, social and relationship and natural, 6 different types of capital. Also to support integrated thinking, decision making and actions that focus on the creation of value over short, medium and longer term. So these capitals are basically rather the traditional way of looking at capital is the financial assets or the financial value of assets such as cash, and the factories, machinery and equipment owned by business and used in production. So basically, the financial resources available for use. So the notion is that companies with a large amount of money, can do a lot or are better off than those with less capital. If you have a lot of money, you can fund projects with positive ROI and then may make more money. So that's the normal, or general notion. But IR talks about 6 different types of capital. One is the financial. That is, an important role in our economy, enabling the other types of capital to be owned and traded. So apart from financial capital, IR talks about manufactured capital. That is material goods or fixed assets which contribute to the production process. Your machines, your tools and buildings, those are known as the manufactured capital. So if you have manufactured capital, you can produce or manufacture more output. And then intellectual capital, broadly be defined as the collection of all informational resources a company has at its disposal. The know-how via your employees. And then human capital, HR. This can be described as consisting of people's health, knowledge, skills and motivation. And then social capital, the institutions that help us maintain and develop human capital in partnership with others, the local communities, the families, etc. And finally, the natural capital, the natural assets that society has, including resources of renewable and non-renewable materials. So what you can see here is reporting occurs from many different angles. So the reader or the stakeholder gets a 360 view of what the company is doing, and like I said, how they are sourcing, transforming and then delivering output. Right, so how to prepare integrated report? IR framework sets out several guiding principles which underpin the preparation. So one is the strategic focus and future orientation. An IR report should provide insight into the organization strategy, basically long term. Also connectivity of information. Like I said, it should provide a 360 view, holistic picture, and the interrelationship dependencies between factors. Then stakeholder relationship, right? That is nature and quality of organization's relationship with its key stakeholders. Also materiality, information about matters that substantively affect the organization's ability to create value. So materiality depends on the size of the business and the context. Conciseness, it should not have a lot of information, but sufficient amount of content covering key aspects. And also reliability and completeness. Your content should be balanced, accurate, should include both positive and negative facts. Also consistency and comparability. The information in an integrated report should be presented on a basis that is consistent over time. Right, you can't be changing the formats or whatnot, because then it's not consistent. So when the data is consistent, it's easy for you to compare and assess performance over a period, and also understand how the organization has been, creating value or adding value. Right, moving on to management, internal control systems and reporting. Internal control attempts to ensure that risks are minimized. Right, for example, you can ask your finance department that 2 people should sign a check. Why? You're trying to minimize risk. If it is 2 people, then both of them will check what the transaction is and what the payment is all about, etc. And an internal control system is network of systems established in an organization to provide reasonable assurance, not 100%, reasonable assurance that organizational objectives will be achieved. And management control is about procedures and policies in place to ensure that company objectives are achieved. Right, so internal control is all about protecting the organization from negative risks or downside risks, and achieving the organizational objectives. So objectives of internal control system: orderly and efficient conduct, including adherence to internal policies, safeguarding assets, prevention, detection of fraud and error, accuracy, completeness of records, and timely preparation of financial information. Right, this fraud risk management is also part of internal control. So we have fraud prevention, detection, and response. Fraud prevention, create an anti-fraud culture. Right, make sure that you pay your employees sufficient amount of rewards in terms of salaries and performance related bonus, right, and set good practices, and create a culture that where they don't even think of fraud. Also create risk awareness. Whistleblowing, create channels for people to inform if something wrong is happening. It's normally, whistleblowing is an informal channel, not a formal channel, right? And then of course have sound internal control systems in place, so that those are some of the ways in which you can prevent fraud. Fraud detection. See, most frauds are discovered accidentally or as a result of information received through whistleblowing. So some methods of discovering fraud: performing regular checks, reconciliations, stock taking, cash count, right? And then warning signals or fraud risk indicators: failures, internal control procedures, lack of information provided to auditors, unusual behavior by individual staff members, accounting difficulties. So these are certain warnings, and of course detect through your whistleblowers. And how do you respond? Fraud response plan sets out the arrangements for dealing with suspected cases of fraud, theft, or corruption. It provides procedures for evidence gathering that will enable decision making that will subsequently be admissible in any legal action. Also a deterrent value and can help to restrict damage and minimize losses to the organization. And the response may include internal disciplinary action, right? That should be set in your HR policies. and when you recruit someone, they should be made aware of these policies. And civil litigation for the recovery of loss, and criminal prosecution through the police, taking them to courts, etc. Yeah, in terms of internal audit, it's pretty much same content as what you learn in F8. Only thing is we will apply to SBL in a more practical manner. There is no new content to learn, so due to the time constraint, I would tell you that you brush up your audit knowledge from F8. Yeah, but I would like to take you through the risk part. What is risk? Normally people think risk is bad. Risk, there is upside risk as well as there is downside risk. Upside is where risk works in your favor. Downside is unfavorable. Now, why do we hedge when it comes to forex? Why do we hedge? To protect ourselves from downside risk. Something like option, a right but not an obligation. So if the exchange rate moves in your favor, you don't do anything. But if the exchange rate moves against you, then you exercise the option. Right? So risk is good and bad. It's not always bad. And any business operates with risk. Day in and day out, there are thousands of risk. So what we should do as a business is that identify those, assess how bad or how good they are, and then put measures in place to protect the company from the negative risks. So why incur risk? By incurring risk, you can gain competitive advantage, and also you can increase financial return. Risk and return are related. Low risk, low return. And if you take more risk, your returns can be higher. So risk management, first you identify, meaning what are the risks that the company is facing. So you put a list. Then you analyze, right? Prioritize. Not all risks are worth managing. Right? If you're going to lose cents, then no point putting a lot of controls in place, because the cost of protecting against that particular risk is more than the benefits that you derive. Risk planning, that is avoidance and contingency, and risk monitoring, risk assessment. You need to do that, because the factors that affect a business will constantly keep on changing. Right? The risks of yesterday are not the risks of today. ERM, or enterprise risk management, is a process effected by an entity's board of directors, management and other personnel, applied in strategy setting and across the enterprise, designed to identify potential events that may affect the entity and manage risk to be within its risk appetite, to provide reasonable assurance regarding the achievement of entity objectives. So basically, it falls back on the director's responsibility to protect the company against any negative risks. Right now, risk we can categorize by strategic risk and operational risk. Strategic risks are, high level risk that can affect the overall mission of the company, or the entire organization. Operational risk affects day-to-day activities of the company. You can also have a category in between called tactical risk, which is functional risk. Also, we can have a lot of categories: market, credit, liquidity, political risk, um, legal risk, environmental risk, depending on where the risk comes from. And then sector specific risk, and general risk. Generic risk affects all business. Specific is affects individual businesses. This is something like systematic and unsystematic. Inflation would affect everyone, but oil price would affect companies that are in the oil industry. So risk assessment is based on how bad the impact is, known as severity, the impact of the risk, and the chance of that it happening. We call it probability, the likelihood of the actual risk occurring. A risk mapping, or we call it a heat map. So based on the level of potential, the chance, and the impact and the likelihood, we can categorize. For example, likelihood is remote, impact is negligible, then you can avoid. You don't need to do anything. But something that falls on 25, you need to be very careful, because highly probable and the impact is also high, right? If, for example, if you are into foreign trade and fluctuations in exchange rate, if it is probable and your losses can be huge, so then hedging mechanisms should be brought in place, internal, external, etc. Right, this is an important model, risk management model. Based on the impact and the probability, you can decide what to do. For example, if the probability or the chance of something happening is high and the impact is also high, then you must avoid it. You must try to avoid it. Otherwise, it will cost the company a lot. If the chance of something happening is low and the impact is also low, then just accept it. Because no point trying to put internal controls in place. It's not worth it. The cost of trying to protect yourself will be more than the benefits you derive. Impact is low, but the chance is high, try to reduce. And if the impact is high and the chance is low, you transfer something like insurance. People don't meet with accidents every day, but when it happens, sometimes it can be really bad. So probability, likelihood is low, but the damage is high, so you transfer. So this is what you call the TARA model, TARA. You can remember it as TARA model, that is used for risk management. You can also manage risk by diversifying. One of the reasons why companies invest in many different industries is that they reduce the risk. Because if you all your investment is in, let's say, ice cream, so if it continuously rains, it's a problem. So you also have a umbrella manufacturing company, so you balance it out. So whether it rains or not, you're still safe. You in both businesses. Right, so I would like you to quickly read the third question, that is risk, and then we discuss the answer quickly. Okay, I'll allow about 3 to 5 minutes so that you can quickly read. BTS company. So this question is on strategic, tactical, and operational risks. I would quickly take you through the different types of risks that are present in this particular scenario. Strategic risk would be IT failure, and then the issues with the distribution system. So IT failure, they must have backup servers, and in terms of the distribution system, they must check for alternative delivery solutions. For example, maybe use a different courier firm, or even purchase their own vans for delivery. And then in terms of tactical risk, it's one is their key staff, and then the suppliers. If you lose the key staff, then what they do and the knowledge along with them will also be lost. So you can look at the possibility of preparing a manual, right? Anyone joining can use that to understand how production needs to be done. And also suppliers. So to avoid this risk, company can look at entering into more partnerships with other suppliers, so that you have constant supplies. Also paying on time, so that you maintain better relationship with your suppliers. Operational risks would be a lack of fabric, right? And of course there are a lot of issues when you have lack of raw materials. And to mitigate this threat, they can implement a computerized reordering system. And also probably you can train your procurement manager, right? Tell him to maintain some form of notes, so that he does not forget, and identify low level of fabric, and then reorder, etc. So depending on the type of risk, you must suggest actions to alleviate, right? So in your exam, exhibits will a particular exhibit will talk about the n number of risks that the company is facing, and then the examiner will ask you how to categorize them, what risks that the company should protect against, and what are the actions to be taken. So this is where your business knowledge is also important. So wider reading about companies is important, watching business programs. There's enough content on YouTube which you can use. So those are ways of keeping yourself updated and knowing what's going on. All right, so I think we have come to the closure of day 2. So I will catch you guys tomorrow with a balance of technical content and few questions. So good night and thank you very much.